Tax office views. Small business. They used to just we're on a self-assessment system. So the tax office used to sit there and say, well, we'll just randomly pick a few people to have a look at. Then we'll go and get more money and look at randomly a few more people, because we figured that out of everyone we look, I think the stats are about 1 in 10 they generate some sort of revenue for it. So I think this year in the budget they said, hey, we'll give the tax office $52 million, and the tax office is supposed to return $400 million in revenue for that. So it's a they've obviously done some modeling. I think there's an 8-to-1 return on every dollar they spend on audit activity. So the tax office has become more sophisticated. They've got more tools now about how they do things. They have a lot more information from us when we lodge our returns to understand what's going on. So when you prepare your tax returns or when you do your business, you need to be careful about how that works, so that you report in line with the industry or in line with a way that will minimise your tax risk. The most common audits are business activity statement audits, so preparing your BASs, and I'll show you some stats on that later on. It's phenomenal how many people get that wrong. One of my largest businesses, and we've just decided that they can't bother to fix it because it's too hard, has been running. They're about $180 million turnover. They actually report the BASs in the wrong entity, and they just keep doing that for every year. I can't believe the tax office actually audited them. They haven't figured that out yet themselves. So we just keep crossing our fingers and saying, let's hope that keeps happening. But when they come through, they have a look at these things and say, well, how much skill do you have in this area? Nobody wants to do paperwork, but if you don't have a system that works, that the tax office can easily understand, and that you can explain to them, your audit risk just jumps up, and you're unlikely to get away with it. Oh yeah, we'll just tick you off. They're more likely to come back and say, okay, what are you guys doing? How does it work? Where's the errors? And they don't generally go away until they get some money from you. At one point, the more and more questions they ask, they're not supposed to be a revenue generating business. That would be their mentality. They've only got so much time. I'm sure that if you've got a case officer that isn't generating any revenue from the audit reviews that they're doing, he's going to be on performance management. So there's an incentive for them to come through and fix a few things. These are some of the things that they like to see. So if they come and ask some questions, they like to see that level of sophistication that gives them a bit of confidence that, hey, the business is truly a business and we're doing things in the proper manner. We're finding the tax office with a number of startup businesses at the moment where they've done everything commercially, they've spent a lot of time and they've lost money. It happens in the majority of cases. Mark's stats before were astounding. Certainly we wouldn't see 90% of new businesses continuing on. But these businesses have tried and failed. It might be a small number, it might be $10,000, it might be $100,000. And the tax office have come through and said, yeah, we don't think that's right. It wasn't really a business. You were just doing a hobby. We're not going to give you a loss for that. So I know you claim that as a tax deduction against your part-time job at McDonald's. We want all of that tax back. And they're very aggressive about that. One of my clients built an Olympic-sized equestrian park. Spent 4 years of her life doing this. Very difficult business to run, obviously. There's a limited market. Distraught that she hasn't been able to generate it, generate enough income. Before that, she sold her last business for $35 million. So a very astute woman. Tax office have no bar. They're refusing to listen to it, saying their argument essentially is who would practically lose money on this. Why would you go and do it? People take risks. I'm trying to explain a commercial approach to them, and they're saying our book says this. Well,
that's because according to the tax office, wasn't producing enough income to justify.
That's right. Concern. Yeah, they sit and say, well, our factor says that a business should make a profit after a couple of years. You haven't made one. Yeah, but this business is special. It does these things. But okay, fair enough. But then why wouldn't you have done these things? Because we didn't. This is how we decided to do the business. They have no commercial acumen. You can't explain a logical argument to the tax office saying we took a chance on the hopes that we'd get a higher return and it didn't pan out. They don't appreciate that argument. They benchmark now. They benchmark a lot of data. Every industry that you're in, they will go through every single tax return that comes into them and put them into a category and take out averages. If you fall outside those averages continuously, they will audit you. They reported this year that they now audit 640 million pieces of data every year. I think it's something like 20 pieces of information a second. They increased reporting so that you used to only have to report if you were a PIOG person. So you give them your salary. As soon as you give them your salary certificate, it comes up onto their portals and they match your tax return part to sit and say, okay, you reported that you earned $20,000, but that certificate wasn't in your return. They don't even ask you the question anymore. They just amend your return and send you the bill. So prove that we're wrong. They get all your bank information, they get all your dividend information, They keep track of all the claims that you made in the prior year, and where your claims substantially differ, they come back and ask you, hey, what's going on here? They still don't do that a lot, but they're getting better and better at looking at the variances between years. So you really, really need to be quite careful about what you're entering through. Some of the things are very simple. From you can claim motor vehicle claims every year. I think every client that I have who's claimed that for the first time, they get a letter saying, "Are you sure that you claimed the right thing?" It's just kind of a, for lack of a better word, it's a scare tactic to make sure that the compliance problems are on you, so that you go back and check your own work and say, "Did I make a mistake?" They're saying if I tell them that I did, I won't have any problems. So a lot of taxpayers just go, "Oh, we'll give them some money back so that they'll leave me alone." And personally, my view is the tax office like that. They're not looking to get money from everyone, but if people are giving something back, even if you're entitled to it, which a lot of clients end up doing, they're ahead. These are some of the benchmarks for MECOs and medical practices. I use MECOs because I did a fair bit of work on that in ILAB. So these are some of the profit margins and net profit ratios that the tax office expect to see on businesses. I honestly have no idea what business makes those kind of margins. I mean, that's phenomenal return. But apparently that's their benchmarks. So if you're outside of that part, your audit risk increases. I'm not sure if they're actually making this stuff up, but it makes you quite scary that when you lodge a return that is significantly less than that, your audit risk automatically goes to the next level. The other key point is if your profitability goes from, say, a 10% net profit ratio to 30% next year and then to 5% the year after, you're asking for trouble. A lot of pharmacies have a tendency to make up the profit at the end of the year by just valuing their stock at a certain number. So they try and keep a level playing field. You need to back that stuff up, because I did meet a restaurant owner for another tax agent. They called us one day and asked for some help. And they had taken the money out of the till every year. And so they bank about half of it and they keep the other half and go out and do whatever they wanted with it. Happened for about 12 years, and the tax office came knocking and said, "Well, over the 12 years you've declared $2 million in income, but we noticed you've got 4 properties that are worth $2 million. Here, AUSTRAC is a service that tracks any money that goes in and out of this country. You've sent $1 million overseas. You've obviously lived on some money. It doesn't make a lot of sense to us how you fund all these assets." These guys were very unsophisticated, and their argument was they wanted the casino. Didn't go down very well, so the tax office said, "Sure, give us the dates, we'll go to the casino and have a look at the tapes and see what happened there." So then they tried to say, "Oh no, it's gifts from overseas and friends and relatives," and they said, "Well, there's no logic of that, because AUSTRAC has seen no money coming in, only coming out." And they kept stuffing the tax office around. So the tax office gave up and they just said, "We've got your bank accounts for the last 12 years. Every time a deposit's come in, we've said that's income." So they went back and just said, "Hey, you owe us $3 or $4 million of tax." Now that was ridiculous, because you obviously transfer money between accounts every day or every second day. So they artificially raised the tax bill. But the tax office view is, well, it's up to you to prove it, not us. So you come back to us and tell us where we got it wrong. They may minimise the tax bill a lot, but I mean, the tax flow itself is one problem. The penalties then are about the same again on top. So you just got to be smarter about these things.
So how did that case wash out?
Well, I mean,
12 years of amended tax returns.
Yeah, well, actually, what they do is they look at the first year and say, they look at the first 4 years and said, averagely we think you missed 86% income this year, 50%, 42, and they just average it, and they just say, we're not going to go back and do this for the rest. We're going to say, on average, you've missed 80% of your income. We're just going to multiply that by what you've done, what you reported, and gross it up.
Yeah, but did the client think it was worth doing their own amended return?
They did. We went through all bank statements and we managed to about halve the amount, but we still didn't have any reasonable argument to stand on. And in the mix, yeah. Well, they also told us they did fortunately do what the tax was accusing them of. At which time we said, well, we can't act for you knowing that information. So
where we go from here?
Yeah. So they really weren't doing themselves any favours in the case. This is analysis of service industry hub that we've gone through and had a look. And I said these slides will be given to you. But these are some of the profit margins we see. We say poor return. That's generally actually a mature business that just hasn't paid attention to the margins. So as the business grows, there's a lot of costs that come through. You hire more people. Some people are great producers to the company. Some, let's say, deadbeats. And you've got to really filing those out and say, okay, well, how do we actually make this company grow? And a lot of companies are very, very poor at managing those people out of their business, and they just let them go linger and put them in a role that has no impact on clients. Sure, but it's still an overhead for you that you've got to go through and suffer. Hard to say. I mean, the nicest people are just the poorest people of business. They will stomach that stuff and let it go through. And you know, if you're only 4.8% versus 23.5%, not because you're being a bad employer or derogatory to your employees, but because you're being assertive and saying, hey, we need you guys to do the job. Well, I mean, that's a phenomenal difference in what you can achieve. These are some of the statistics. So the tax office say on average, 1-2 people get their VAT statement wrong. So simple things from actually not having a tax invoice. The number of times that we've seen clients claim GST on residential premises, for example. You go and buy a house, and then you claim GST back. First of all, why are you buying a house in a company? And secondly, there's no GST on that in the first place. So the tax office always, if your refund is above about $10,000 these days, and it's your first BAS that you've lodged, you always get a review. It's simple now, because so many people have defrauded the system that they want to check it out and they have a look. And it takes 2 seconds for them to ask you, give me the tax invoice. You don't have it. So they come back and say, okay, well, we're not going to give you the $10,000 that you say you're entitled to, but we're also going to penalise you $10,000 for trying to claim it. They've got very low tolerance for these things at points of times. And the rest of these issues are really about administration problems, about whether or not you've got the right accounting staff, whether you've recorded the information correctly. As I said, the more boxes you can tick, if you go and make this mistake, you can come back and say, look, I'm really sorry, it was an accident. And if you can prove these things, they'll go, okay, well, don't worry about the penalty, just don't get the income this time, don't do it again. Very easy to make that argument to the tax office when you have everything else right. Dealing with the tax office, don't deal with them yourself. I mean, I don't want to wail on public servants, but a lot of them have no interest in what they're doing. They're not really excited about their job, but they've got a lot of supervisors that are. So if you go and tell them something, well, you better be damn right sure it's correct, because they'll just harp on it until, well, a lot of people get frustrated and start yelling at the tax office. That's not a good idea. If you annoy the person that's auditing you, well, they just keep auditing you. They have no reason to stop. So get someone to represent you, because we don't say, a lot of work is actually not responding at all. They'll call us and say, tell us all these things. There's a taxpayer charter that says they actually have to write to us and ask the question. So we'll listen to what they say. We'll say, well, look, send us a letter. We're not going to respond to that on the phone. We're not going to do this. We're not going to email you. I mean, you have a good sense of who you're dealing with once you get a developed relationship with these people, and we respond accordingly. Some words last years. I've taken the tax office to the courts a couple of times. On one issue, phenomenally ignorant of the own law. Like, they've come through and said, oh, we think it means this. I'm like, no, you said it this time, it means that. And they wouldn't agree. So you've got to go through a process that says you object, then you've got another process that takes a couple of months, and then you can go to court and come and say it's right. When we got to court, we actually wrote to the tax council and said, you guys are going to court on this issue, seems a bit ridiculous to us. They rang the case off and said, you're an idiot, drop it. Give them back the money. So, as I said, you just need to know the right people to get these things through. And always respond to deadlines. I can't get over the administration part. So many audits happen because people don't pay attention to their own tax affairs. If you ignore the tax office request, generally they sit there and say, okay, fine, they'll send you a demand, another demand. A business that apparently is quite profitable that's come to us, they just didn't respond. They couldn't pay their bills at the time, they just didn't go back and talk to the tax office. The tax office just gave up and wound them up. Said, here's your notice, you've got 21 days to pay us or your business is done. So now they're asking for our help. I'm like, well, our help would have been good 6 months ago. Right now, all we can tell you to do is wind your business up before the tax office asks you for the $300,000. So you can still get out of the debt if you act in time, but now you've lost your business. We could have saved it all before. That's all I wanted to know.
Right.